With net 30, you're not a cash flow business. You're a bank with negative interest. This might be a harsh statement, but this is exactly what happens if you use net 30 as a payment structure for your agency. And I know that because over the last 2 years, I analyzed over 100 of agencies and saw their inside out of their operations. What we are covering: why you have chosen net 30 as a payment structure. So when you get paid 30 days after you have closed the deal on a sales call. Second, why net 30 is actually financial suicide. There I break the whole math behind net 30 down, and then how to fix it. Before I break down why this is complete financial suicide, let's professionally consider the actual pros of that. First, it's easier to close deals. You want to make your clients happy and give them extra breathing room for their cash flow. You want to be nice, and it looks professional because you have these crazy complex payment terms that makes your business looks professional and legit. Oftentimes, this is actually a industry B2B standard for big corporations in the world. So you might be thinking, oh, well, if I use these payment structures, I attract bigger clients because they require those payment structure of net 30, 60 or 90 because their accounting apartments run on specific invoicing cycles and you want to adapt yourself to those invoicing cycles. If you're not an agency for Apple or any other big corporations with net 220 terms, then you don't need that. Those agencies have very 5 and even sometimes 6-figure deals, while you invoice a client with 20, 30K and then they bring just their operations in-house. Those big corporations run also on very complex approval processes, taking up to 2 or even sometimes 4 weeks just to get a decision right. But this is not a simple agencies with the goal of signing a couple of clients for 2K and then scaling up to a couple of grands each month or to 6 figures. You don't want these clients anyway. Now, let's break down why clients who pay late will leave you stuck at your revenue ceiling you just broke through. Let's run the numbers for 2026. And if you don't change payment terms this week, by June, you will be in danger zone where growth makes you poorer. By August, one late payment could mean you cannot make payroll. Same work, same clients. Let's assume you're at 10K a month right now. I want to scale by the end of the year to 140K by December. Your retainer is 3K with about 1,000 delivery cost. On paper, that is 2K profit each client. It looks healthy until it doesn't. But let's look at what actually happens to your bank account. The red line is net 30. The green line is a DSO of 0 days, so you get paid immediately. Same revenue, same clients, same work. The only difference is when the money hits your account. By December, with a DSO of 0, you have roughly 680,000K a year. But with a net 30 payment structure, you have about 456K a year. That is a 20K a year gap. Not from working harder, just from when you collect those payments. And maybe you think, oh, well, that's not a big problem because you get the money anyways. Yes, that is technically true, but with a cash flow business, you want to focus on cash flow and not building evaluations. And the gap grows as you scale. And I call this whole concept bad debt losses. At the beginning, there's no real difference, but as you grow, the bad monthly debt is getting bigger and bigger. And this red graph is exactly the line that shows the opportunity cost that you have with this money. The cash trapped in your account is growing linear, but your opportunity cost is growing exponentially. But let's look actually at the month by month breakdown. So I am just assuming that you have this typical payroll structure of your agency: media buyer, virtual assistants, and all your employees. So this right here is your revenue. Then on the next column is your cash left over, your net 30 final. And it's the exact same as right above here, what you have right now in your bank. The DSO 7 final is the exact amount of cash that you have right now in your bank. And here is the exact gap between what you have and what you could have. And those bad debt losses are exactly those numbers that get lost if your clients don't pay you anyways after 30 days. And when we now consider to your cash left over, your team payroll, I should actually add another column to represent that. Then you are left with this column minus this column. And then you can actually see your numbers and cash left over. This is a simplistic example, and there are also a lot of other variables playing in that example, and it's a really important thing to consider how you construct your backend, because if you only rely on front door sales, it's actually a really dangerous game because you are constantly forced to bring cash into the door and cannot rely on your backend. So just because the numbers are here quite good or not good, it can also be the exact opposite because of your backend structure, but that is a different topic. So now let's look at the real opportunity cost. Let's assume you're already in March here with those numbers. With a DSO of 0 days, you are left with 80K profit after your payroll and maybe also different expenses you have to consider there. But then you have already built your cash reserves up to 74K. That is a runaway of 7.5 months, and you could already hire employees to even grow more. But compared when you are having a payment structure of net 30 until March, you are left with monthly profits after your payroll with about 10K. Sure, you have some cash reserves, but you have just a runaway of roughly 2.5 months. With that, you can hire people, but it's getting really tight and you have to pay attention and be really sure that next month you're getting sales through the door. Therefore, you have to also wait another 30 days for your payment. So that is the actual problem when scaling, because scaling is about acting fast, and you can't act fast if all your cash you made, you have to wait 30 days to get that cash. Plus, on top of that, if you have to pay your contractors in a terms of net 15, then you are really tight because you don't get paid before you have to pay your contractors. And if you pay your contractors also maybe in net 30 terms, then it gets really close, but you can get the cash in. But when your clients don't pay the cash immediately after the net 30, so 30 days, it gets really tight. But let's look at a scenario with a DSO of 0 days. Then you can easily see your revenue and team expenses, and therefore also the monthly profit without worrying about when the cash is finally hitting your door. Because considering all these numbers in this big table is pretty overwhelming. And also, if your clients don't pay at all, you just lose money. So you get paid immediately and you get the cash while you grow. You can invest that profits again into people, softwares, automation, or ads. But especially with ads, it's also an investment. You have to wait a specific amount of time to get the cash back. But on top of that, you have also to wait another 30 days to get that cash from your clients. So when you add the time frame when you have a sales calls that closes with a net 30 payment structure and add that on top of your net 30, so 30 days, you have even bigger cash flow constraints. And especially when you want to scale fast. Enough said. Here's how you can actually transition from net 30 payment structures to a DSO of 7 days. First, you need to get actual sales through the front door. So you get paid immediately, not with a net 30 payment structure. Because now you have leverage. With that new cash, you can fund your back end safely. Now you have leverage to go to your old clients and openly say you change your payment structure. And if they cool with that, then good for you. But also if they just say no, which is actually pretty risky because you had a contract with a specific payment terms, then you can ask for that favor, but still have a proper business with cash flow. See your clients that have still a net 30 payment terms as those clients that give you extra money on the next month while running your business on those new clients with new cash flow and considering those expenses from your current month for your old clients as extra expenses without a proper return on that, because then you're actually safe and everything else is just extra. You can only maybe consider those net 30 or 60 or 90 payments structures good cash reserves built over time, because then you can act from a position out of abundance and from a position of financial strength. Then you actually maybe care about your evaluation, about your agency. When you're at this point of your career in your agency, you actually can consider using revenue or evaluation as a first metric to improve on your business and not just focus like in the beginning of a cash flow business, because when you are starting an agency is a cash flow business, so you can use that cash to go on different ventures and use those cash flows. But besides that, you're running a charity and being exploited and not running a proper cash flow business.